Alright, today is 4/20, and this is a recap for the stock market activities today. We saw a lot of de-risking, reducing exposure before earnings. The majority of stocks in the market are up big year to date, and perhaps some of these stocks are already pricing in the good news but not pricing in the bad news due to elevated stock prices. Now the bad news we have been receiving from the companies that reported earnings is pretty much concentrated in inflation. Companies are reporting that input costs are increasing rapidly, and therefore they have to raise prices for the end customer. Now, certain companies are able to increase prices without suffering loss of market share or any competitive advantage. These are the names that this quote-unquote bad news of inflation will actually be beneficiary for these companies. On the other hand, companies that cannot afford to pass the extra cost to the end customer and they have to eat it up, these particular companies will suffer from margin shrinkage because they have to absorb the extra input cost. Likewise, if we continue to hear from other companies reporting earnings and talking about the input cost increases due to inflation, then the market will come to the conclusion that perhaps inflation is worse than the Federal Reserve is projecting it to be. And if that is the case, then the market will have to cut valuations across the board, specifically for the high multiple, high valuation names. You have to remember, the technology sector and the high valuation names suffer the most when inflation rises higher because the end result of inflation is increasing interest rates. When interest rates rise higher, the present value of future earnings gets diluted. Now, all of these companies with high valuations in the technology sector are valued based on future earnings. So when interest rates are lower, the stocks of these companies became in favor. But when interest rates start to rise higher, then the present value of these future earnings shrink, and therefore these stocks fall out of favor. So this is one theme we're watching, and we will continue to watch as more and more companies report earnings. The other thing is, yesterday we talked about the inflation in chips, the chip shortage. Today we will talk about the lumber shortage. What are the reasons behind lumber prices surging impulsively higher? What is the long-term trajectory for lumber prices? We will also talk about market sentiment because it seems that we have two markets. One market that continues to go higher and higher and higher, no problems at all. Matter of fact, the year-to-date performance is extremely impressive. Yet we have another market that seems to be popular specifically with the younger generation of investors, specifically those who joined the market last year during the March bottom. And this market is in a lot of pain. They're talking about the crash and bear market, frustration. The sentiment is very low from the retail side, specifically in that particular market. So we will talk about the contrast between the two markets. Furthermore, we will talk about Tesla's crash in Texas. We have new information and the implications that will have on Tesla's stock. And we will talk about the technical developments in the markets and the charts, specifically for the 10-year Treasury yield. But before we do that, let's start by covering how the market closed today. And here we go. The Dow Industrial Average closing in the red, down 256.33 points, or a decline of 0.75%. The Nasdaq down 128.5 points, or a decline of 0.92%. The S&P 500 in the red, down 28.32 points, or a decline of 0.68%. And what about the sector's performance for the day? We saw a decline, a rejection for the 10-year Treasury yield, and right away that is very beneficial for utilities, coming up number 1 in capturing the gold medal, a number 2 for the silver, real estate, and a number 3 for the bronze. Even though weak closing, defensives. We saw a lot of pain in certain tobacco stocks, and that is adding to the lack of overperformance for defensives, because we saw an overperformance from traditional defensives like Procter & Gamble, Kimberly-Clark, PepsiCo, etc. The laggards of the day led by energy, financials, and cyclicals. What about the advance to decline ratio for the New York Stock Exchange? And this is stunning. 80% declining versus 19% advancing. So it is a decisive day to the downside. Likewise for the Nasdaq. 80% declining versus 18% advancing. Also a decisive down day for the Nasdaq. Moving on, futures. What's going on here? Declines for crude oil, not massive declines, but noticeable. A little over 1% for the WTI, a little under 1% for Brent. What about softs? Check this one out. Lumber closing in the red, down. And the question is, did we just see a top in lumber? And will lumber prices pull back? And if that is the case, then that will open short trade ideas, buying puts for names like Home Depot and home builders, the likes of Lennar, D.R. Horton, etc. But today was a deflationary day in many aspects. Oil prices down, lumber down, copper down, and yields down. Nevertheless, that did not help the Nasdaq or the mania high valuation names. So the market is sending mixed messages. What we can extract right now from the action is that we are seeing de-risking, reducing exposure, and taking profits prior to earnings. What else in softs? Declines for coca and OJ futures. Meanwhile, gains for sugar, coffee, and cotton futures. Sugar futures acting sweet, leading the outperformance in softs futures. What about metals? The US dollar stable, bouncing higher slightly today, yet we saw gold also trading a little higher. And the reason is the decline in the 10-year Treasury yield. So gold is tracking yields better than it is being influenced by the US dollar movement. Nevertheless, we saw declines for copper, and Dr. Copper is very sensitive to the US dollar. It likes a lower dollar, not a higher one. So on days when we see the dollar bouncing higher, copper registers losses. Likewise, we saw losses for platinum and palladium futures. Meanwhile, silver futures pretty much flat for the day. What about meats? Lean hogs, the big tech. Another day scoring yet more gains for lean hogs futures. A slight rebound for live cattle futures. Meanwhile, the losses continue for feeder cattle futures. What about grains? Big bounces here, big up day for grains, and the gains are led by soybean oil, canola, oats, corn, soybeans, wheat, and soybean meals. The only laggard for today's activities, rough rice futures. Moving on to the big casino, the options market, and here is a summary for today's activities. At number 1, the most traded options for the day were for Apple, with a little over 1.4 million contracts traded today. About 77.5% of those were calls. At number 2, Tesla, with about 450,000 contracts, about 57% of those were calls. And number 3, NEO, with a little over 340,000 contracts, about 70.5% of those were calls. All in all, muted activities in the casino today, per usual by the way. The last couple of weeks, it has been extremely quiet, and the bets remain the same. Buying calls on Apple, buying calls on Tesla, buying calls on NEO, buying calls on Palantir for the 100th time, hoping that today is the day. Nothing new. What about the unusual activities that took place in the options market today? Starting with the ticker PFSE. This is a SPAC that is supposed to take pay safe to the public market, as we haven't learned anything from the SPACs of Chamath, Spacaria, and the collapse of Nikola and CCIV. Anyways, they're making a bullish bet here by buying the 14 calls, expiration date June 18th, with expectations that the name will rise over 10% by then. And they paid about 75 cents apiece to enter this trade, all in all bringing the total to about $900,000. What about the trade for the ticker triple Qs, the Nasdaq? We have a big bearish bet here, buying the 303 puts, expiration date July 16th, with expectations that the Nasdaq will drop over 10% by then. They paid about $5.80 a piece to enter this trade, bringing the total all the way to about $6.8 million. What about the ticker AMKR, precious metals? They're making a bullish bet by buying the 24 calls, expiration date May 21st, with expectations that the name will rise over 5.5% by then. They paid about $1.40 a piece to enter this trade, all in all bringing the total to about $1.2 million. What about the trade for the ticker XLE, the energy ETF? Betting on a bounce here, a big one, buying the 52 calls, expiration date June 30th, with expectations that the name will rise 10.5% or more. By then, they paid about 90 cents a piece to enter this trade, all in all bringing the total to about $600,000. What about the trade for the ticker FUTU? We have a bullish bid here buying the 155 calls, expiration date April 23rd, meaning this upcoming Friday, with expectations that the name will rebound over 13.5% by then. They paid about $1.30 a piece to enter this trade, which brought the total all the way to about $800,000. What about the trade for the ticker CROX for Crocs? We have a bullish bid here buying the 80 calls, expiration date May 21st, with expectations that the name will rise over 7.5% by then. They paid about $3 a piece to enter this trade, bringing the total all the way to about $1.6 million. Moving on to the headlines that shape the day, starting with macro news. We talked about corporate earnings and the warnings we received so far from at least two companies, Coca-Cola warning about inflation, saying that they will raise prices and pass the extra cost to the end customer. Today, we heard from Procter & Gamble, similar story. Expenses are rising for many retail and consumer goods companies as a result of increased consumer demand and strains within the global supply chain. Procter & Gamble will raise prices on baby care, feminine care, and adult unconscious products in September. Like other consumer companies, P&G is seeing higher commodity costs that are eating into its profits. This is the challenge when we pick the inflationary names, the inflationary stocks. You're looking for companies that can pass the extra cost easily to the end customer and perhaps even benefit from the rise of inflation. Procter & Gamble is a mixed bag. Yes, they can pass some of the cost to the end customer, but it still has a lot of exposure to commodity prices. But the message is clear. Companies are feeling the pain for inflation. By the way, the Federal Reserve says that inflation is at 1.5% right now, and they wouldn't mind if inflation rises all the way to 3%, meaning doubling. So if these companies are facing difficulties now, what will happen to these companies' margins and bottom lines if inflation indeed rises to 3% or more? And here is the story of lumber. Lumber futures have been on the longest winning streak in history. The price of lumber is up over 200%, and pre-COVID levels might never return. For all of you who keep saying, oh, where is inflation? Is it here? Is it there? And even if it is here, it's going to be transitory and the supply chain will catch up and the prices will go down. And even if inflation is not transitory and prices continue to increase, then Papa Jerome got the tools, bro. Well, here Fortune magazine is saying, don't expect lumber prices to decline to pre-COVID levels. Not going to happen. Why do they say that over at Fortune magazine? Here it is. When the pandemic struck last year, shutdowns caused sawmills to halt production. At the same time, quarantining Americans rushed to Home Depot and Lowe's to buy up materials for the do-it-yourself projects. That supply and demand mismatch caused lumber inventory to plummet. Remember our discussion last night when I showed you the gap between the supply and demand, and I told you that this time it is different because you pushed the demand way higher and the supply chain has a lot of catching up to do. Furthermore, the demand is not slowing down. We have more stimmies and more spending with no stop and sign. Therefore, the supply chain is struggling to catch up, and perhaps at these elevated levels of demand, it will take the supply chain a lot of time to ramp up the production and catch up with the demand. By that time, the damage has been already done. Inflation is skyrocketing and commodity prices are through the roof. Continuing, it only got worse from there, aided by recession-induced record low interest rates. The housing market boomed in the summer of 2020. As that market got hotter and the existing home inventory fell, buyers turned to new construction. Of course, new homes require a lot of lumber, thus exacerbating the shortage. On the supply side, production is finally rebounding. Wood production hit a 13-year high in February, but due to limited mill capacity and labor shortages, that alone cannot solve the shortage. Classic economic theory suggests surging prices should help to dampen demand. That hasn't happened yet. Pay attention. That hasn't happened yet, meaning that the increase in prices has indeed deter the mania. Matter of fact, home buyers are offering cash above the asking price. What does that tell you? The mania is not over yet, and housing prices will continue to surge higher and higher and higher. This will be one of the biggest housing bubble, if not the biggest, in history. In fact, the demand for lumber has only gone higher. This is very important, even for you as an investor, because if you are betting that the housing bubble will bust right now, you are probably wrong. We will see ups and downs and pullbacks, but the main theme is the mania of home buying hasn't stopped at all. It might slow down at some point, but if home buyers are convinced that inflation will rise higher, and we have already reached the bottom for interest rates, and interest rates will continue to rise higher from here on, then they will stampede and buy homes at any prices, pushing that housing bubble to become bigger and bigger and bigger. Tight-budgeted do-it-yourselfers don't want to hear this, but pre-pandemic lumber prices might never return. I don't think we ever go back to levels we had prior to this boom. Michael Goodman, director of specialty products at Sherwood Lumber, told Fortune magazine. Now, why is this important? This exposes the bullshit narrative that inflation can just be transitory. Bullshit. It has never been proven in the history of economics. Once you unleash inflation, it is here to stay. It has to run its course. There is no magic wand to kill inflation without causing severe depressions. And the reason is, we talked about wages, labor wages, yesterday and the day before, that once you start paying people 15 and 20 bucks an hour because you are struggling to find workers, qualified workers, you can't go back and say, well, we're going to reduce salaries and now wages are going to go down from 20 bucks an hour to 15, back to 10. It doesn't work that way. Once you unlock that inflation reaction, people get used to it. And now they expect that wage, the higher wage. Likewise, for producers in lumber, for example, they have now uncovered that the customer is willing to pay more and able to pay more. So to say that these suppliers are going to dump the prices all the way back to pre-pandemic levels, that's baloney. They know that the demand is hot and the consumer, even after the bubble busts, is still capable of paying more if producers ask for more. The psychology is very important when it comes to inflation. And here comes the demographics. You know, the demographics, bro. But the demographics. Here comes the demographics. Demographically speaking, we are going to need a lot more lumber in the years ahead. The 5 largest years for millennials, or millennial birth, occurred between 1989 and 1993. There was a shortage of condoms back then. And we are currently in the 5-year window when this seismic group of younger millennials will hit the age of 30, an all-important age for the first time home buying. A poll conducted by Fortune in April found 54% of these young buyers, the young millennials, plan to buy a home in the next 5 years. So there is a tsunami of new buyers looking for new homes, and the supply is not here. And old-timers are living more and more, longer and longer. They're not going to give their homes away unless they need to, and therefore the supply will remain tight, and the inflation in lumber prices and housing prices will perhaps last for many more years. So watch out for this one. Home affordability, when that declines, what are the implications? In a socioeconomic perspective, lots of people will find housing unaffordable. Homelessness crisis all over the place. And perhaps when the government goes all in MMT, giving everybody a UBI because the jobs got automated over at Amazon and the likes, they're going to build these capsules. They give you a UBI, digital money deposited every month in your digital wallet, and you get to live in a government capsule. Check out my crib, bro. Come over at my capsule. I get 10 minutes of sunshine every day. How lucky am I? The total number of homes for sale in the United States has dropped over 50% in the past 12 months. That means builders and lumber yards should remain plenty busy, meaning that if we see a pullback in lumber futures, that will be an opportunity to buy. The dip will be bought in lumber futures, regardless. That is, if supply can keep up. Currently, sawmill capacity is too low, and even if capacity grows, it does not fix the limited supply of Canadian softwood lumber, which, unlike abundant southern yellow pine, is the go-to for framing homes. Oh, but the demographics, bro. Perhaps the United States will produce chainsaws and we will invade Canada and chop up their forest. That's deflationary, isn't it? If the production factors remain that are limiting log supply, I find it hard to believe that we return to historical price ranges. Stinson Dean, CEO of Dakin Lumber. And what is the Federal Reserve doing, by the way? Are they addressing the problem? Are they at least being honest with what's going on with inflation? Nope. They continue to do propaganda and bullshit by turning a blind eye. Here is Federal Jerome Powell says we do not need or we do not anticipate high inflation, but have the tools to address 1970s type pressures if they arise. And rumor has it that Volcker took another role in his grave. Fed's Powell, U.S. recovery seems to be improving. So wait a minute, you're saying that we're not going to see inflation, and even if we see inflation, we got the tools, bro. And now you're saying that the recovery is improving. So are you going to taper, Mr. Powell? Oh, no. We're not going to taper. We're not thinking about anything. We're just going to leave everything as is and see what happens. These mad scientists. Powell says too low inflation harms American families and businesses. Here comes the bullshit, the propaganda. Or deflation harms American households. But the inflation that the Federal Reserve is ushering right now that is supposed to be helpful to American families, well, wages hasn't been increasing for forever. We are finally seeing wages pick up just a notch. A little bit, but way behind inflation. Meanwhile, as I just covered for you, housing prices are through the roof, and housing affordability is becoming a very big problem in this country, causing a homelessness problem all over, in addition to a lost generation of millennials in their 30s and 40s not being able to afford a home. The American dream is dead for these people. But Jerome says, deflation is actually worse for American households, the poor and middle class, than inflation. Give me a break. What about this, Mr. Powell? The U.S. poverty rate rose 11.7% in March, the highest level yet during the pandemic. So, if your policies are spot on and increasing inflation by printing money out of thin air and flooding the system, and by the way, the majority of that money is going to the pockets of the rich and corporations. 99% of the money liquidity from the printing machine is finding its way in the pockets of the 1%. And poverty is actually increasing because the gap between the poor and the rich is the widest in history. And more middle-class families are falling down back into poverty due to higher inflation. But hey, the Federal Reserve doesn't care about these poor bums. Why don't you work a little harder? Find a job, you poor bum. You're lazy. Let's move on from the poor to the poor and visit the rich. What's going on in rich land? Let's see the plight and the struggles of the rich. What are the issues that our beloved 1% oligarchs have to face? How about this one? They're also facing housing prices going higher. I feel so bad for them. 10 millionaire enclaves where home prices have appreciated the most during the pandemic. And here it is. This is where the rich is moving. Summerlin, California. The median list price is almost $20 million. Of course, this is a very nice area by Santa Barbara. There are a few pockets of California that are still nice, but only the rich can afford to live there. One of them is Summerlin, Montecito, Santa Barbara. Doesn't matter. But perhaps when some of these rich find some spare time and perhaps some pocket change while they're at it, maybe they would think about using their money for some good for humanity, the planet, wildlife, by saving the elephants over at Zimbabwe. Zimbabwe is planning to kill 500 elephants. They'll give you a trophy hunt. If you want to poach an elephant, if you're an asshole, degenerate, psychopath, and you've always dreamt about shooting an elephant, well, now you can do that for $70,000. And you can wash your guilt and your assholeness away by saying that, I'm just contributing to help saving the elephants. How about some of these rich assholes, these trillionaires, Jeff Bezos and Elon Musk, donate $40 million to save 500 elephants? Step up, you greedy But bro, the population of elephants is getting out of control. How about the population of human beings, right? The worthless human beings waste the space. How about that overpopulation? And the rich have a lot of money. They can afford not just to save 500 elephants, but they can save 500,000 elephants if they want to. And instead of bragging with an elephant skull in your living room, as if you are Hannibal Lecter, how about you brag to your rich asshole friends that you are the new Noah? You saved the elephants. Because here it is. Last year was a good year for the wealthiest Americans. The top 1% saw their wealth balloons by about 35%. Meanwhile, the next 9%, their wealth increased by about also 35%. The next 40% saw their wealth grow by about 26%. In the bottom 50, the majority of Americans only saw their wealth increase by about 4.1%. And where is this wealth coming from? Well, it is coming from the inflation in real estate values, at least for the majority of Americans. But here is the take: corporate equities and mutual fund shares. Who controls the majority? The overwhelming majority of wealth in the securities market. The top 1% overwhelmingly own the majority of wealth in the securities market, meaning when the Federal Reserve props up the stock market via the cocaine operation of printing money out of thin air and showering Wall Street with free cash, fueling speculations and bubbles all over the place, that ends up benefiting the 1% the most. Not the 10%, the 1%. Meanwhile, the donkey retail traders chasing these asset prices higher and higher, they find themselves participating in a cycle of boom and bust. Meanwhile, these top 1%, they get to dump and make a ton of money, raising the cash, and when the market crashes, on the top of the heads of the retail participation, these same 1%ers use their cash and buy the dip in the stock market at cheaper prices, lather, rinse, repeat. Lastly, in macro news, we have a survey here giving us an inside look into Gen Zers and millennials and their streaming habits. 26% of Gen Zers in the survey cited playing video games as their favorite entertainment activity, compared to about 40% listening to music, 12% browsing the internet, 11% engaging on social media, and only 10% said they would rather watch a movie or TV show at home. So the Gen Zers are busy playing video games. They're not interested in streaming as much as they are interested in video games. And rumor has it that 100% of Gen Zers shit their pants when they receive a phone call. You know, because you have to text. If you call somebody with all the social anxiety that is going on, if you make an eye contact, God forbid, somebody makes an eye contact, says hello, all of a sudden you freeze, right? Oh, what do I do here? Another human being, an actual human being talking to me face to face. I'm not programmed to do that. I'm only programmed to communicate with other human beings digitally. And what about millennials? Born 1983 and 1996. 18% chose watching movies and TV shows as their preferred mode of entertainment. Video games was about 16%. So millennials like streaming more than playing video games. Nearly half, 49% of respondents said the top reason they would cancel a video subscription service would be because of price increase. Are you listening, Netflix? This comes as many top streaming services, including Disney Plus and Netflix, have enacted small price increases to improve revenue per user, a key factor when determining the success of a streamer. Still, content remains a big deal, with 31% saying they would be most likely to quit if the shows and movies they liked were removed. This is very interesting. Moving on to sentiment news. What about the bros over at YouTube? You know, the financial gurus, the geniuses that they are. Last year, we had a mania, the heat of the bubble, an extreme bull market, and everybody looked like a genius because it didn't take much to be a genius in a hyper bull market where valuations don't matter and it's all about momentum. All you have to do is put your blindfold on and pick a stock out of a hat, pick a ticker out of a hat, boom, and you're making money. And now you are a genius. And people are following you on YouTube and social media as if you were some financial guru. But now that the tides are changing and the market is becoming extremely difficult to navigate, all of a sudden, what's going on with the market? This is so difficult. Oh, we need to take a break. We need to take a break from the market. And they are very confused because they're saying, oh, but everything is good news. The economy is reopening. We have more stimulus. More growth, higher corporate earnings. Why? Why is the stock market not working anymore? Ironically, they did not ask the same question last year. Why was the stock market rallying impulsively higher every single day when we had nothing but bad news in the market? The answer is the market has become a cocaine addict. That is the only thing that the market cares about. And the cocaine is fiscal and monetary liquidity. When the Federal Reserve ushered the tsunami of liquidity and interest rates collapsed, this was a prime environment for risk-taking in the equities market, and therefore valuations did not matter, and stocks continued to go higher every single day with no fundamentals whatsoever, specifically the stocks that these geniuses like and hype up on social media. The Plug Powers, the NEOs, the CCIV, Tesla, etc. Now that the tide is turning, interest rates are rising higher, inflation is rising higher. Remember, bad news is good news for the stock market because it means more cocaine. But if we are heading into good economic news, this is the market's worst enemy because good news eventually means that the cocaine operation will be halted and the market is a drug addict. It hasn't been rallying based on fundamentals and corporate earnings. It has been rallying solely based on the cocaine. You cut the cocaine, it's over. And the market is looking forward. Every time we have good news, we get closer and closer to tapering. And therefore, you have to choose your stocks wisely. This is not a gambling casino anymore. This is a stock picker's market. And in a stock picker's market, the truth is revealed and you find out who is actually knowledgeable about investing versus the YouTube personalities, the influencers who got lucky under a very easy market. The truth is, the market is still hot. The market is at all-time highs. The Dow, the Nasdaq, the Russell, all-time highs. So why are these bros complaining and finding the market extremely difficult to navigate? Because they are concentrated in a few handful of garbage names. And you can thank these influencers, quote unquote, because they buy these names ahead of time. They buy call options and then they go in their YouTube channels and they hype up these names, convincing retail traders, amateur traders, and investors to follow their footsteps. When it works, they look at the guy and they say, oh, what a genius. But again, it's an easy market. You place your chips anywhere on the roulette table and you will score. But now the tide is turning and you have nobody else to blame but these influencers who've been hyping these garbage names with no regard to valuations, fundamentals, macroeconomics, whatever. And now we have a lot of bag holders. The difference between you and the quote-unquote influencers, when they gamble in the casino buying call options and they lose, all of what they have to do is dump more videos on your head, 5, 6, 7 videos a day with 100 ads being jammed up in the video, and they make the money back. They got more chips and they go back and gamble at the casino. You do not have that option. Furthermore, you know some of these geniuses have millions of subscribers. And here is one of those geniuses giving you his Biden portfolio earlier in the year. And here are the performances for his picks. Bad. Matter of fact, his whole Biden portfolio is down 17.5%. So I don't know what happened. Did Biden die? Do we have another president today? Meanwhile, contrast that with the maverick of Wall Street's Biden's portfolio. Big numbers. One of us actually knows what they're doing. The other doesn't. And by the way, here is this difficult WTF market for you. Here it is. You would think we're in a bear market. We saw a crash. Here is the reality. Microsoft up over 16%, Oracle 22%, Fortinet about 39%, AMAT 51%, Bank of America almost 30%, Google over 30%, Exxon 37%, Freeport over 40% gains. Year to date, Deere over 41.5% gains. This is year to date, by the way. Kroger over 17% gains. Tell me again, what's wrong with this market? There's nothing wrong at all. You guys are just holding the bag in very few names that were very popular in the social media circles. These names were hyped up based on no fundamentals whatsoever. The fundamentals always matter. Momentum lasts for a moment, but fundamentals last forever. And by the way, what are the retail crowd chasing? They were chasing names like Nikola, for example. You don't have to go all the way back to the dot-com bubble to find examples. You can go back to last year. Look at what happened to Nikola stock. And yes, it is a fraud. We know the story. But look at this chart. At the highs of Nikola, what was the sentiment? Did they even anticipate the crash that is about to come? Of course not. The sentiment was extremely arrogant. And the con man CEO and founder of this company walks away with millions of dollars, even though he is a fraudster. Yet the retail investors and traders are the ones holding the bag. Another one. What about SPACs? Your boy Chamath. Hedge fund giant warns of SPAC blow up after betting $1 billion. This guy's betting $1 billion against SPACs. Hedge fund giant Marshall Wace is ringing alarm bells about the booming SPAC market after building up long and short bets on blank check companies, aka SPACs, that total more than $1 billion. The SPAC phenomena will end badly and leave many casualties, Marshall said, while disclosing that the firm has more than $1 billion of gross exposure to SPACs in its flagship 21 billion Eureka hedge fund. And now the newest trend is Dogecoin. And we all know how that movie will end as well. Doge is now worth more than Ford. How about just investing in rational, sound companies with earnings, with profits? What is the appeal of chasing this stupidity when the odds are not in your favor? It will be a fun ride while Doge continues to rise higher, but once the bubble busts and we see the sell-off, the likes that we saw with Nikola and SPACs and others, what happens then? And of course, this generation of investors, their idols include Chamath, who already betrayed them, Elon Musk, and Cathie Wood. Cathie Wood said this. Cathie Wood said that. Who cares? Who cares? Cathie Wood is a gambler. Here's a proof. She just started the space ETF. And the poster boy stock for space is Virgin Galactic. Now Cathie Wood is dumping Virgin Galactic from the space ETF. And rumor has it she is replacing Virgin Galactic with McDonald's in the space ETF. Why not? Is it a space ETF anymore, or is it another scam to suck up more and more investors' money? Moving on to corporate-specific news, starting with the iMob of Apple. We had the big anticipated event, the event of the century, where Apple would reveal their new innovations. And here it is. Wait for it. New colors. This is the newest 21st century's innovation, the iMob. Colors. Oh, wow. New colors. Wow. Oh. Apple announces new iMac models that come in different colors. Wow. Whoa. Very futuristic. Apple just unveiled a new color for the iPhone 12. Purple. Ta-da! Apple announces new Magic Keyboard with trackpad in white color. Oh, this is the future, bro, right? Shall we add another trillion to Apple's valuation based on new color optimism? Because here it is. The Chinese are not playing games. The Chinese are making money and they're spending the money on new innovations, research, and development. Meanwhile, our companies, chiefly Apple, spends the cash on crap like new colors. That's their innovation, in addition to shares buybacks. And this practice will not just fail Apple against the Chinese competition, but it will eventually fail this entire country. We will lag behind in innovation thanks to companies like Apple. Of course, the executives could give a rat's ass about Apple or this country. They care only about their pockets, inflating the stock price via share buybacks so they can dump and become richer. No long-term vision whatsoever. And what about the drama with Tesla, the souffle? What's going on here? It is getting crazier and crazier by the day. This will be a case study and a very significant event in Tesla's history. U.S. sends team to probe fatal Tesla crash in Texas with no driver. Now we have two different federal agencies investigating this crash. And things got a little muddy here and complicated because Reverend Elon Musk decided to go on social media and say that the car did not have an autonomous system installed, and there was no way that this was due to the autonomous system. Meanwhile, we have a vehicle without a driver crashing. So what's going on here? Is it due to paranormal activities? Because somebody's lying here. Either the authorities or Elon Musk. Had he kept his mouth shut, said nothing, we were all under the impression that the driver was reckless by misusing the autonomous system. And that's that. It's not Tesla's fault. Now, Elon Musk is going all in. This is a high-risk move because if it turns out that he's lying or manipulating the data as we speak right now, so the authorities would not be able to find the truth, boy, that might drop the end credits on Tesla and Elon Musk. His reputation will be gone. And Tesla's facing trouble in China, not just the US. Tesla knocks keep coming as China chides over vehicle safety. And you guys saw the popular video online on social media of the Chinese woman protesting Tesla at the Shanghai Auto Show. So the reputation of Tesla is getting hammered. And by the way, what kind of uncourteous asshole, a total whack job, instead of offering condolences to the victims' families and saying let the investigation take its course and we are here to collaborate and help the authorities with whatever they need, he goes on social media like the psychopath he is and says what he said. Elon's been totally irresponsible, said the faculty chair of autonomous vehicles engineering at Princeton University. It is not a game. This is serious stuff. And this is, by the way, not the only expert criticizing Elon Musk. We have a lot of professors and engineers in the autonomous vehicles arena criticizing Elon Musk and his lack of sensitivity and seriousness regarding this issue. Moving on to the heat map analysis, we are seeing a sell-off across the board, profit taking across the board, specifically in the winners year to date. And the reason is reducing risk and exposure before earnings. Whether we're talking about inflationary names, momentum names, it didn't matter. Profit taking across the board, with very few exceptions related to earnings. For example, IBM outperforming today with gains of about 4%. IBM reported earnings yesterday. We also have Johnson & Johnson reported earnings in the morning, along with Philip Morris. That name managed to close in the green with gains over 2.5%, even though the Biden administration is proposing limitation on the amount of nicotine being used in cigarettes. Now, this is being portrayed as bad news for the industry, but wouldn't reducing nicotine in cigarettes encourage smokers to buy more cigarette packs to get the fix? And this is exactly what the market is debating. Philip Morris in the green, meanwhile Alteria, the ticker MO, closing severely in the red. And we saw massive losses for this name during yesterday's session as well. Moving on to the themes analysis, what's going on here? Let's start with the reopening trade. Losses across the board, profit taking across the board. And the reason is these names are the hottest names in the market right now. Massive gains year to date, massive gains since the elections of last year. And all of these gains were built up on the reopening and vaccine optimism. Some of these moves were overdone, in my opinion. Take a look at Disney, Marriott, Hilton, Live Nation. These names are trading above the pre-pandemic highs. This is a recipe for disaster heading into earnings, because earnings will not justify where the stocks are trading. It's going to come down to guidance, and if guidance is a little soft, you will see big sell-offs in these names. So the preferred scenario is we see profit taking prior to earnings, taking some of that air out of the bubble before earnings. So even if earnings disappoint, or in this case, the guidance, you're not going to see crashes or massive double-digit pullbacks in these names. These names will come back in favor, but they have to give up a little. They have to correct the massive impulsive move since the elections of last year. What about the inflationary trade? What's going on here? Mixed performance, but mostly in the red. Also profit taking, specifically from the highest performers, the likes of Alcoa, Martin Marietta, Deere. And this is a healthy practice prior to earnings. You don't want stocks to head into earnings with the most bloated, highly elevated levels ever. We know the market overall is heading into earnings with these characteristics, because the number of stocks trading above the 200 days moving average, and we covered that chart a few videos ago, the percentage is pretty much at the highest level ever, meaning that the market is severely bloated, not just in the technology and momentum or growth, but also in the inflationary, reopening, and value stocks. Finding value in this market is extremely difficult, and therefore you want to see many pullbacks, 5, 6, even 10% before earnings to reduce the shock after earnings if earnings disappoint. Moving on to the deflationary trade. We saw yields retreating today. That should be good for these deflationary stocks, specifically the high multiple mania names. That is not the case today. We saw declines in names like Snapchat, DoorDash, Shopify, DocuSign, ServiceNow. Not massive losses, but the underperformance is noticeable, even though you have favorable conditions of lower yields. Moving on to the charts analysis, starting with 30 minutes chart of the SPY. We had a bear flag formation, and that indeed played to the downside today. We managed to close one of the gaps, but we have a lot more to go. We have a formation of another bear flag from a 30 minutes perspective. However, the MACD indicator also has an imminent crossing, creating green impressions in the histogram. Now, this is a 30 minutes perspective, so it is very limited. But the take here is we could see a gap higher tomorrow, and the test will be the follow-up. Will we reverse again, sell off, close below the lows of today? If that is the case, then that will be a confirmation for a massive sell-off to follow. If we do gap higher and we close above half of the body of the bear flag pole, then this was a mere dip and we will see more buying in the days to come. I doubt it. After a massive run higher in a short amount of time with low volume, you have to go down and have a correction of at least 5% or so before moving higher. And my target here, how about the level of 406? That will be a good level to retest and catch support from. Moving on to the daily perspective for the SPY futures. Once again, we are in a breakout under low volume, but the last couple of days, volume has been picking up higher, but it is picking up higher on the downside. This is exactly what I told you. Every time you see an impulsive move higher with pumps overnight, gapping higher on very low volume, institutional buying, passive income buying, that is usually followed up by a big flush down with higher volume. And once again, the level we're looking at is 3,960. We do have the gap. It'll be interesting to see the reaction of the chart if we reach all the way down there. But looking at the RSI, overbought conditions, and the MACD indicator curling downward, about to create red impressions in the histogram, we could easily fall down all the way to 3,960 and retest that level for support. Moving on to the Qs, 30 minutes chart. Once again, a bear flag followed by another bear flag. We managed to close two gaps. We have a lot more to go if we want to go downward, but the level of 330.5 is a good short-term support to target, with the level of 323 being the ultimate target and the center of gravity. But as we saw with the SPY from a 30 minutes perspective, we also have a crossing imminent in the MACD indicator for the Qs. So again, we could gap higher, but the reaction will be very important. What you don't want to see as a market bull is the gap and crap scenario, because that will be a confirmation for the bears to double down on their bets. Moving on to the NASDAQ futures. Daily perspective. What's going on here? Once again, I told you the level of 13,900 is a sacred level. You're not going to be able to just blast above it with no consideration whatsoever. You got to spend a little bit of time here. You got to go back and forth, gathering more energy, more volume, higher volume to break above that level decisively. We have a negative divergence in the RSI and a curling downward in the MACD indicator, and the chart is about to register red impressions on the histogram, meaning that we have further down to go. And the next target is the purple trend line in or around the level of 13,599. This is the next support. We should at least bounce higher just a little bit, at least intraday from this level. And the ultimate level is 13,300. That should be a solid support. We should see a bounce from that level. Breaking below that level, that would be a death sentence for the Qs. What about the IWM, small caps? The underperformance today is coming from small caps. We talked about the bear flag formation. We saw the flush down and yet another bear flag formation. So what's next now? We have a crossing imminent in the MACD with 30 minutes perspective. That should take us all the way to at least 218. If we get rejected again, then we have lower prices to go. But this is a steep, massive move in a short amount of time to the downside in the Russell 2000. We should expect at least a mini bounce before resuming the trajectory downward, because once again, the Russell is dependent on the reopening names and GameStop. Today, we saw massive profit taking in the reopening trade that impacted the Russell 2000 negatively. What about the daily picture for the RUT 2000? We are eyeing 2,264. The chart is struggling to break above that level. There is a massive move coming. It did not happen to the upside. The logical conclusion is that it will happen to the downside, with the negative divergence in the RSI and the imminent crossing in the MACD indicator to the southern territory, indicating increasing momentum for the bearish turnaround. What about the dollar index? The dollar index bouncing higher from 91. Could it build up, go all the way to 91.5? That is possible. But the take here is the bullish trend has been broken. The dollar index is a headless chicken right now. It could bounce back all the way to 92, but the trajectory is lower. It has to go back all the way to 90 and then figure out the next direction, up or down. And what about gold? Gold rallying higher today, modestly speaking, even though the dollar is also bouncing higher. And the reason is yields were down today. Yields have a bigger impact on gold prices than the dollar index, at least these days. And perhaps the buy here, if yields continue to decline, are not technology names or momentum names, but perhaps it is gold, even though the performance is not impressive to my taste. You have a massive leg down in yields and the dollar index, and gold barely rallied here. We did not see a massive move higher all the way to 1800 and beyond. I'm not impressed by the move in gold. What about Bitcoin? What's going on here? It is starting to look a little scary. The price action is stabilizing from whatever shock it was over the weekend. There are rumors were behind the collapse over the weekend. Others are blaming it on an outage in China, etc., etc. Who knows? What we know is there is profit taking from the big whales in Bitcoin. We are now in the calm before the storm. We have already broken the trend, not just the higher highs and higher lows. That remains slightly intact because we did not make a lower low. But the trend itself, as you can see from the line in yellow, is broken. The question is, can you climb above the trend line by tomorrow? And the chart will give Bitcoin a few days to try and reclaim the trend line. If that doesn't happen in a day, 2, 3 at the most, then the next move will be to the downside, because this will form a bear flag formation, and that will play to the downside. What about yields? We talked about the level of 1.6, specifically 1.62, as the next resistance. We went all the way there and pulling back, getting rejected decisively, meaning the yields can go all the way down to 1.5, and that should be a solid support for yields to rally higher. The problem is, from the price action today, that this is not a relief for tech investors, specifically the high momentum retail names, the likes of Plug Power, Blink Charging, Palantir, because one would assume that the move downward in yields will be beneficial for these names. That was not the case today, and it was not the case last week, and that keeps the mystery alive. Why aren't these names bouncing higher even though yields are retreating? The weakness is extremely evident in these names. Even when yields go down, they refuse to rally. And the bag holders in these names, I know we make fun of you all the time, but you have my empathy, because it is very frustrating, specifically in a name like Palantir, for example. Buying call options every day with no result. The stock continues to go down pretty much every single day now, and it is becoming very frustrating for the bag holders in Palantir. And you have to read the psychology here. If you're a bag holder in Palantir, for example, and you continue to buy the dip day after day and it doesn't work, and the stock continues to go down and down and down, you're going to reach a level of frustration here, where you're just going to pull the trigger and say, all right, I'm out of this. I can't handle the stress and the fact that the market is going higher every day. Meanwhile, these stocks that we are following, the solar names, NEO, Plug Power, Palantir, not moving at all. That could be a trigger for the next leg down in these names. If the frustration boils down to hell with diamond hands, let's pull the trigger, cash in whatever capital left, and we can deploy that in better investments and better trades. Moving on to the TLT, we talked about the battle of two bull flags. One of those will play. The bull flag in yields already played to the target of 1.6 and then retreated, got rejected. Now we have the other bull flag in the TLT that should be playing out higher, and the destination will be in or around the level of 143. Moving on to the VIX. We talked about the VIX. Take advantage, buy protection when the VIX is trending lower, because puts are cheap, but they're not going to stay that way if the VIX continues to surge higher. Now I'm anticipating that the VIX will explode higher, beyond 25, perhaps all the way to 30. So you got to start accumulating protection and perhaps some bearish bets while the put option premiums remain cheap. Moving on to the big kahuna, Apple. What's going on here? We talked about sell the news from the Apple event, new colors, big deal, who cares? All of this accumulation in Apple shares the last couple of weeks, we are talking about a stock worth $2 trillion, moving almost 10% in a couple of weeks, moving 10% higher, creating about $200 billion in market value. Now that we are heading to earnings season, and Apple will report earnings Next week, you're going to see a lot of reflection and you will see profit taking also hitting Apple. And the destination, at least in the short term, is 131. Lastly, what about Tesla, the souffle? What's going on here? No significant move today. The stock bounced higher earlier in the morning after Elon Musk threw cold water on the idea that the autonomous system was involved in the crash. But we saw those gains fading away quickly. Yet Tesla managed to close in the green and at the support level. The stock will be extremely sensitive to the flow of news in the next coming days. And you know what levels you have to look forward to. Closing below 679, that will be a shorting signal. But if the stock goes all the way higher, closing the gap once again at 781.30 before the end of the week, then my strategy will be exploiting the price action to open credit spreads, selling calls to benefit from the elevated premiums of call options prior to earnings. So I do have a strategy here to play Tesla stock prior to earnings, but I would like to wait and see the price action in the next few days before I do that. Moving on to the conclusion of this video. We got earnings from Procter & Gamble and Johnson & Johnson in the morning. Both companies warning about inflation. And after the bell, we got earnings from Netflix. And Netflix shares are trading lower by the tune of about 10% after hours. Last time I checked. Now, if Netflix is down, it will indeed open down 10%, then the Nasdaq will also open gapping lower. And you will see that bear flag formation we talked about in the charts analysis playing out because Netflix has a huge weighting and it is a leading indicator for upcoming FANG and big cap technology earnings. And of course, the geniuses that they are, they're using the cash not to build more content and become more competitive in the streaming wars. They're using the cash to buy back shares. I think investors are not happy with this decision because why would you buy shares right now at these elevated prices when you can use the cash to produce more content and open a wider gap of advantage with the competition? This is a very bad decision by Netflix, but once again, these executives are greedy and they're out for themselves. They're looking to get richer. They could care less about the company or its future. They're looking for immediate gains and therefore using $5 billion for share buybacks to prop up the stock price higher. Tomorrow we have Verizon before the bell, and after the bell we have Chipotle and Lam Research. Chipotle will be important because we are transitioning from the stay-at-home, which was very beneficial to Chipotle, to the reopening phase, favoring stocks that will outperform during the reopening, not the lockdown. Chipotle happens to be a hybrid name. It thrived under the lockdowns and stay-at-home environment, and the assumption is that the company will continue to thrive even after the lockdowns are over and the economy is fully reopened. So it will be interesting to see whether the market will continue to excuse the high valuations for CMG, or will there be a factor that will act as the last straw that breaks the camel's back? And then we have Lam Research, and Lam Research is one of the best performers years to date. And the reason is the chip shortage. Lam Research is involved in the infrastructure building of chip manufacturing. We know that at least in this country, we will start building factories and ramp up chip production because it is becoming a national security issue. That is very beneficial for Lam, and therefore Lam has been rallying impulsively higher. The question is, have we already priced in the good news? The earnings from Lam Research will be extremely important because it will act as a leading indicator to how other stocks that have been rallying higher, impulsively higher, will react when they release their own earnings. We're talking about AMAT, Nvidia, Qualcomm, even General Motors, names that have been running hot since the election of last year. Lastly, we continue to watch the price action in Dogecoin. Today was Doge Day and Doge was down about 20%. So will the bubble pop? And if Doge goes down, and it turns out that it is a quick pump and dump scheme, how would that impact the morale in the market? Whether it is Bitcoin or equities, will a crash in Dogecoin have a contagious impact in the stock market as well? That is the $1 million question. Anyways, that's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.